Here's something I discovered that most people never figure out. Your brain doesn't actually care how much money you spend. It cares how you spend it. And once I understood that, I realized I had been making financial decisions that looked completely rational on the surface, but were quietly costing me thousands of dollars every year. Not because I was irresponsible, not because I didn't know better, but because my brain was running a system I didn't even know existed. Let me explain what I mean. A few years ago, I was tracking my spending for the first time, and I noticed something that genuinely confused me. I would agonize, genuinely stress over buying a $5 coffee. I'd stand in line thinking, do I really need this? That's $150 a month if I do this every day. But that same month, I was paying for a $129 software subscription I hadn't opened in 4 months. A streaming service I watched maybe twice a year. A gym membership at a location I drove past but never entered. When I added it up, I was spending over $1,400 a year on subscriptions I barely used, and yet the $5 coffee felt like the problem. I needed to understand why, so I went deep into the research. What I found is that psychologists and behavioral economists call this mental accounting. The term was coined by Nobel Prize-winning economist Richard Thaler, and once I understood it, everything about money psychology clicked. Mental accounting is the tendency to treat money differently depending on where it came from, what category we've assigned it to, or how it's structured, even when the actual dollar amounts are identical. Your brain doesn't process all dollars as equal. It never has, and most financial advice completely ignores this. So let me show you exactly what's happening inside your head when you make these decisions. When you buy a $5 coffee, the pain is immediate. You hand over money, you feel it leave, there's a direct, real-time connection between the action and the cost. Psychologists call this the pain of paying, and cash creates the sharpest version of this pain. Studies have shown that people spend up to 83% more when using credit cards versus cash, because swiping a card numbs that pain significantly. But with a subscription, the pain happens once, usually months ago when you first signed up. And after that initial moment, the cost becomes invisible. It sits quietly in your bank statement, buried between other line items, charging you while you sleep. Here's what I found in the research. A 2022 study by the subscription management platform C+R Research found that the average American underestimates their monthly subscription spending by $133 per month. People thought they were spending around $86 on subscriptions. The actual average was $219. That gap, that $133 blind spot, is mental accounting at work. Your brain didn't update its internal ledger when the subscription renewed. It filed it under already paid for, even when it keeps charging you going forward. Now think about what $133 a month actually is. Over 10 years, invested at a modest 7% return, that's over $22,000. Not millions, but $22,000 is a car. It's a year of rent in many cities. It's a financial cushion that most Americans don't have. The Federal Reserve's 2023 report on the economic well-being of U.S. households found that 37% of American adults could not cover an unexpected $400 expense without borrowing money or selling something. 37%. And yet, subscription spending in the U.S. hit $593 billion in 2024. So we're in this strange position where millions of people are financially vulnerable, but still hemorrhaging money to services they forgot they signed up for, while simultaneously stressing about the cost of a cup of coffee. This isn't stupidity, it's psychology, and the companies selling subscriptions know exactly how it works. This is where it gets interesting. The subscription economy didn't become a $593 billion industry by accident. It was engineered around the specific quirks of human mental accounting. Spotify doesn't charge you $120 at the start of the year. They charge you $10.99 a month because $10.99 feels trivial. Your brain categorizes it as basically nothing. But $131.88 a year for music you might also consume on YouTube for free. That's a real number.
The same logic runs through every SaaS product, every streaming service, every subscription box. Fracture the price into small monthly chunks, automate the billing so it never triggers the pain of paying, and let mental accounting do the rest. I found a McKinsey & Company analysis that showed subscription businesses have grown by more than 435% over the last decade. That's not because subscriptions are inherently better for consumers. It's because they're dramatically better for businesses, specifically because of how human psychology responds to recurring low-friction charges. Here's another layer. When we do spend money actively, the coffee, the dinner, the impulse buy, we feel it. We judge ourselves, we track it, we tell ourselves to cut back. The visible spending gets scrutinized. The invisible spending, it operates below the radar, and that's precisely where the money quietly drains.
Here's the heaviest part of this. The problem isn't that you don't care about money. It's that your caring is misdirected. You're watching the wrong accounts. But here's where it gets even more interesting, because this isn't just about subscriptions. This same mental accounting bias is running in the background of almost every major financial decision you make, and once you see it, you can't unsee it. Here's what I realized after going through all of this research. The $5 coffee isn't destroying your finances, but your relationship to visible versus invisible spending might be. What nobody talks about is this. There are two completely different financial systems running inside most people's heads simultaneously. One system handles what I'll call active spending, decisions you make in real time with real psychological friction. The other handles passive spending, money that leaves automatically with no decision point at all. And here's the truth. Your brain only governs one of those systems. The other one runs on autopilot. The research on this is striking. A study published in the Journal of Consumer Research found that people felt significantly more financial pain when paying in cash than when the same amount was charged automatically to a card. The experience of paying, the act of it, is what triggers the brain's evaluation response. Remove that experience and you remove the evaluation. This is why subscription companies don't just prefer auto billing, they depend on it. They know that the moment a customer has to actively renew, cancellation rates spike. The friction of the decision wakes the brain up. I found data from Zuora, a subscription analytics company, showing that involuntary churn, when a customer accidentally leaves because their card expired, is often lower than voluntary churn, when a customer actually chooses to cancel it. Think about what that means. More people forget to update a credit card and accidentally leave it than actively decide to cancel it. That's not a coincidence. That's the architecture of passive spending. It's designed to minimize the moments where your conscious brain participates. And here's the part that should make you genuinely uncomfortable. The average American adult has 4.5 active paid subscriptions, but they can only recall about 2.9 of them from memory. That means, on average, roughly 1.5 subscriptions exist in someone's life that they wouldn't even think to cancel because they don't know they're paying for them. The $5 coffee, you know about it, you feel it, your brain processes it. The $14.99 you've been paying for cloud storage you set up in 2021 and haven't accessed since? Completely invisible, completely painless, and completely ongoing. But here's the part that took me the longest to figure out. Because it's not just about subscriptions at all. The same mental accounting error shows up in how we think about debt, savings, bonuses, and even raises. And the pattern is always the same. Let me show you how deep this goes. Mental accounting doesn't just separate active from passive spending. It creates entirely separate psychological buckets for different types of money, even when those buckets are financially identical. Here's a real one. Tax refunds. The average federal tax refund in 2024 was $2,869, and the research is consistent. People spend tax refunds differently than they spend regular income. They're more likely to make discretionary purchases, take trips, or buy things they'd normally consider too expensive from a paycheck. Economically, that doesn't make sense. $2,869 is $2,869, whether it comes from a refund or your salary. But mentally, a refund feels like found money, a windfall, separate from your normal budget, and so the rules change. This happens because of a cognitive principle called source labeling. Your brain tags money differently based on where it came from. Money you worked for weekly gets one label, normal income, spend carefully. Money that arrives as a lump sum gets a different label, extra, can be used freely. I used to think this was irrational, but the research shows it's actually a predictable, near-universal cognitive pattern. What looks like reckless spending is actually the brain following its own internal accounting rules, rules it developed automatically, without your permission. Here's another one, the sunk cost trap. This one runs deep in subscription psychology. People often keep subscriptions they don't use because they feel they've already paid for them. I should get my money's worth. But the money is gone. It's already spent. The only relevant question is, does this service add value going forward? A 2021 study from the University of Chicago found that gym members who paid monthly were more likely to continue a membership they rarely used than those who paid annually, because monthly billing created ongoing, repeated sunk cost justifications. Each new charge renewed the internal pressure to get their money's worth. This means the subscription model doesn't just capture passive spending, it generates sunk cost psychology with every billing cycle. The companies get paid, and you feel like you should use something you're already not using. Both happen simultaneously. This happens because the brain treats each monthly payment as a new emotional investment, not as a continuation of something already bought. Each charge refreshes the psychological commitment. What looks like loyalty is actually a fresh layer of sunk cost applied monthly, like painting a wall that doesn't need painting every single month.
Now, let me connect this to something larger, lifestyle inflation. I used to think lifestyle inflation, the tendency to spend more as you earn more, was about ambition or desire. I thought people just wanted nicer things as they got richer. But the research tells a different story. The primary driver of lifestyle inflation isn't desire, it's passive spending creep. As income rises, people don't dramatically change their active spending habits. They add subscriptions, they upgrade recurring services, they move to a slightly more expensive apartment, a new passive charge that renews automatically every month. The 2024 Bureau of Labor Statistics Consumer Expenditure Survey found that housing, transportation, and personal services, which includes most subscription categories, account for over 68% of average household spending. And almost all of that is recurring, automatic, and largely invisible in day-to-day consciousness. The coffee you debate every morning? That's maybe 1 to 2% of your budget. The invisible architecture of recurring charges? That's the majority. I used to think the path to financial stability was discipline. Control your impulses, resist the coffee, don't buy the thing you don't need. But the truth is, discipline applied to visible, active spending while passive spending runs unchecked is like mopping the floor while the tap is still running. If that landed for you, good. Because here's the part I wish someone had told me sooner, and it comes with a specific number that changed how I thought about this entirely. Let me show you what this actually costs over time, not in emotional terms, but in math. The average American with the standard 4.5 active subscriptions combined with the $133 monthly underestimation gap we looked at earlier is spending roughly $1,600 per year on subscriptions they either don't use or don't remember they have. Now, let's say someone conducts a full audit of their subscriptions at age 30. They identify and cancel $150 per month in services that don't add meaningful value. That's $1,800 a year freed up. If that $1,800 per year is invested consistently at a 7% annual average return, which is roughly the historical inflation-adjusted return of a broad S&P 500 index fund, by age 50, that single change produces approximately $73,000 in additional wealth. $73,000 from canceling subscriptions you weren't using. Compare that to the popular skip the daily coffee advice. If you drink one coffee a day at $5 each, that's about $1,825 a year, almost identical. So yes, mathematically, the coffee does matter. But here's the key difference. The coffee is a conscious choice made daily. It's a pleasure you actively experience. The unused subscription charges zero joy and does the same financial damage invisibly.
The research also shows something important here. When people cut active spending to save money, deprivation psychology kicks in. Restriction creates resentment. Resentment creates binging. This is why aggressive budgeting often fails, not because people lack willpower, but because the brain responds to perceived deprivation by eventually overcorrecting. Cutting passive, invisible waste, things you genuinely don't notice or value, doesn't trigger that response. There's no loss, there's no sacrifice, there's just reclaimed money. The mental shift that actually creates lasting change isn't about resisting the coffee, it's about auditing the autopilot. If I had to do this over, I would start with one thing, a subscription audit. A single, honest inventory of every recurring charge leaving my accounts. Not a budget, not a savings goal, not a restriction, just a list. Every service, every monthly charge, every annual renewal, written down and evaluated on one simple criterion. Does this add clear, regular value to my life, or does it primarily add to my "I should use this more" guilt pile? This isn't a complex system, but the research backs it up consistently. A 2023 study from Cornerstone Advisors found that consumers who conducted even a basic subscription audit reduced their monthly recurring spend by an average of $31 without feeling like they'd given up anything meaningful. The mental shift that actually works is moving your attention from active, visible spending, where your brain already runs natural friction, to passive, invisible spending, where your brain runs almost none. Because here's what I know now that I didn't know then. Financial health isn't primarily about discipline, it's about architecture. The structure of how money moves through your life matters more than willpower, and subscriptions are a structural problem, one that willpower alone was never designed to solve. The companies in the subscription economy understand your brain better than you do. They built their entire business model around the gap between what you notice and what you pay for. The only response that actually works is closing that gap, not with more discipline, but with more information. Here's the final thought I'll leave you with. The $5 coffee isn't a moral failure. It never was. It's visible. Your brain evaluates it honestly. You know what you're getting. You decide. The real question isn't whether you should buy the coffee. It's whether you've ever asked the same question about the 1.5 subscriptions you forgot you had. Your brain wasn't built for the subscription economy. It was built for a world where spending was physical, visible, and immediate. The modern financial system evolved around that weakness on purpose. Knowing that doesn't fix everything, but it changes where you look, and that changes everything else.